So, good morning from Munich and a very warm welcome to our webinar, Factoring Opportunities and Implementation of State-of-the-Art Receivables Finance. We have the following agenda for you today. First of all, we will present the key findings of our market survey, Factoring for the New Era, New Perspectives Through Digitalization and Platforms, which we conducted among 140 treasurers, CFOs in Germany, Switzerland, and Austria. Second part and the main part of our webinar will be the case study on a digital multi-bank factoring program. We are the CRX Marketplace. And last, we want to give you an outlook in the field of receivables finance. And before we start, there's a chat where you can post your questions at any time. At the end of our webinar, we also have a Q&A session, but maybe you don't want to wait so long. So please feel free to post your questions immediately. Just that you know who we are, some nice pictures of us, quite old, I would say. My name is Tim. I'm responsible at CRX for the sales and account management department. I am with CRX for more than 6 years and used to work before at the Deutsche Bank and the working capital advisory and structuring team. Next to me is Daniel.
A very warm welcome also from my side. My name is Daniel, heading the business development at CRX Markets. So I'm also part of the client coverage and sales team. And I have the pleasure today to present you some of the findings of the survey we did, and looking also very much forward to all of your questions.
So that you know who CRX is, only a very quick introduction about CRX. CRX was founded by the founding team of 360T to bring more transparency, more competition, automation into a bank and factoring dominated market. We are live since end of 2015. We started actually on the approved payables finance side, or maybe you know this better as supply chain finance side. So there we're offering different solutions where the buyer can offer their suppliers an early payment, being it via dynamic discounting. For example, if there's excess cash and the supplier requests an early payment, you as a buyer can then pay the supplier against the discount early, or in reverse factoring structures where the early payment is performed by a bank. This is actually today not focused on our webinar. We want to focus on the receivable side. And end of 2020, we went live with a multi-bank factoring solution, which we will present in more detail later. What is actually important to know about CRX is we are live in more than 55 countries. The platform, the marketplace, is currency agnostic, and we work with more than 50 funding partners so far. Usually the seller of the receivables or the buyer, they can select the funding partners. It's never a dark pool of funding partners, and it gives you then obviously the flexibility to work with your relationship banks. It gives you also then the benefit that you can do a kind of wallet sharing, that every relationship bank gets a part of the business. Those who know 360T are quite familiar with the process, and CRX is more or less built it the same, but for the trade finance market. This, as I promised, only a very, very quick introduction about CRX, and we would jump directly to the first agenda point, and therefore I would hand over to Daniel.
Thanks, Tim. So the first agenda point is about the key findings of our market survey. Again, it's called Factoring for the New Era, New Perspectives Through Digitalization and Platforms. This study was conducted together with a very important German financial decision maker magazine. It's called the Finance Magazine. Some of you may know it. And we conducted this survey amongst 140 decision makers. This includes CFOs, head of treasuries, and other people working in a treasury or finance organization. In this, or like the participants of this survey were like a broad range of the German-speaking economy. So it's not only German corporations, it was also conducted in Austria and Switzerland. The biggest industry sectors were like the mechanical engineering industry, the vehicle manufacturing industry, chemicals, and others. So what was our goal in the survey? It was to get like a better assessment of factoring as an instrument in the field of receivables finance. What are motivations for corporations to implement these kind of solutions? But more importantly, what are current challenges when implementing this? And we also wanted to know, where do you see trends in this area? So as this also helps us to further develop our solutions offering and really provide state-of-the-art factoring solutions. As you can see, also from a company side, on the right-hand side is the graph. It's very broad. So the survey included some smaller corporations, but also large global enterprises from really globally active corporations. The first question was about, what instrument are you using already in the field of receivables finance? And the clear winner, if you want to say it that way, so the top instrument and is factoring, so with 71%. And this was similar for smaller corporations and also large corporations. This is also reflected in the growth we see in Germany, but I would also say globally, in the area of factoring. So in Germany, we have 115% of growth in factoring over the last 10 years, which is pretty impressive, and it's still growing. This is also, or we can also see this in discussions with our clients, as factoring used to be an instrument where corporates were a bit reluctant to make use of, because they were fearing bad reputation if they have to sell their receivables. But this, from our perspective, completely changed. The trend is also very positive. So 280 billion in factoring volume are kind of planned for this year. And this is, I would say, very impressive. The second most used tool is participation in a reverse factoring. So here it's pretty clear that this is mainly accessible for larger corporations. Why is that? From our experience, this is mainly due to the fact that the supplier onboarding has involved some efforts. So corporations are mainly focusing on their top suppliers when they do the supplier onboarding, and it's more difficult to include smaller suppliers. This is kind of what we also at CRX Markets try to change, so that we have an easy onboarding process where you can easily also include the long tail of your supply chain and to make this tool also accessible for smaller suppliers. The second top tool used is the sale of individual receivables, and then we see some other tools like asset-backed securities. So the clear financing mix for a small corporation is really focusing on factoring. Large corporations also get access to reverse factoring programs. So why factoring? We now do a little poll where we would like to get your current motivation if you're planning to implement a receivables finance solution, or you already implemented one. So why are you doing this? What is your motivation? The poll will be open for about 1 minute, and we are quite excited to see your answers.
And don't be shy, it's anonymous. So
we did this poll already 1 or 2 times, and the answers were always different.
Are we good to go?
Perfect. So we hope you all can see the results. If not, like the two top priorities or motivations are increasing liquidity as well as optimization of the balance sheet with 36% both. The second one is we have two second places. So one is mitigate default risks with 14%, as well as support the sales team or the sales department also with 14%. Interesting. So what did we find in our survey? You can see this here, where we asked for the main motivation for the utilization of receivables financing. The top priority here is really increasing liquidity. This was with roughly 80% the biggest motivation for most of the corporations, and you can see it was relevant for both small and large enterprises. Second one is balance sheet optimization. So here we are mainly talking about true sale transactions. So the transaction is really off balance. And the third one with 40% is lowering the default risk. So if you maybe have credit insurance or not, factoring can also be, if it's a true sale, a very interesting instrument to get rid of customer risks. The second question here is, what are the most important criteria while choosing an offer? Here, the kind of three top answers were like, first of all, the costs. The costs are very important when selecting a provider, when selecting a solution. Important to mention here is that we are talking about the overall costs. So this not only includes a financing rate or any platform related costs, this is also structuring fees and the technical integration fees. Another top priority is the simple technical integration and automation. So this was a bit kind of also surprising for us as we thought, yeah, this is an industry very well established. All of the factoring providers have existing interfaces, integrations, but still corporations see a lack here on this side and would pick a provider who's able to offer an easy integration and automation into the systems. The third topic is security regarding the balance sheet. So this is really meant in a way that you want to have really the kind of financing security here, that if you want to sell receivables and you need liquidity, that there's a solution in place which offers you this kind of flexibility, and you don't have kind of the maybe duty to sell. Yeah.
I think very interesting the study we conducted in the DACH region, so Germany, Austria, Switzerland, and it fits perfectly more or less to the case study we want to present today. And our client with which we went live end of 2020, they spoke obviously with loads of banks, with loads of factoring providers, and then made up their mind, okay, what are our criteria? What do we need actually to implement a factoring or a receivable solution? And number one was obviously the flexibility for them, because the seller of the receivables is cash rich, to be very fair, and they wanted to have the complete flexibility in terms of the financing volume, the frequency when they are going to sell receivables. So in this case, for example, they started only to sell receivables at quarter end or year end, and then wanted to have, when they, for example, are active on the M&A market or wherever, also say, okay, but tomorrow we also want to sell receivables. So obviously this is quite a challenge. I come to this challenge later when we speak about who are the funders for such a program. The next criteria, and this goes on and on with the transparency and the competition, they fit together, I think, very well. It was very important for them that they have the transparency in terms of infrastructure costs on the one hand, and then financing costs on the other hand. And that's why they were always a bit, not happy at the end of the day with the bank or factoring solutions, because they could never separate these costs. And at the same time, they wanted to do a kind of wallet sharing, but at the same time, they wanted to put these banks, the relationship banks, in competition to each other to really achieve the best pricing when they are going to sell the receivables. Another important criteria was the scalability of such a solution. So they obviously started in Germany, then went out or did the rollout in Europe. But for our seller, it was important that they can use the same technical infrastructure, the same solution also for in the US, where a major part of their business is done. Then everything what they are doing should be automated. So the accounting team of our seller was very early involved in the discussion, and they said, look, when we are working with many banks and we are going to sell different debtors, then obviously I'm sorry, I forgot to mention this. It was also then a criteria that this is an undisclosed structure. So the client of our seller should not be informed about the sale of the receivables. And that means that the seller remains also the collection agent. And therefore, the accounting team said, look, the dunning process, everything has to stay in-house. That's why we need a kind of automated solution. And that means, for example, that the recording, posting of the sale of receivables till the payment of stored receivables back to the financing banks should be completely automated. In order to work with different banks for the same factoring solution, the contracts, the receivable purchase contracts, they had to be consistent. This was an additional challenge. I come to this in more detail in a bit. And then obviously also what we saw in the survey, the accounting treatment was very important. It had to be a true sale, that they can optimize their working capital KPIs and other KPIs, because otherwise it would not have made sense to implement such a solution. So based on these criteria, we said then, okay, we understood. We did the workshop with this client, and then we were already developing such a solution. But first of all, we had to do a gap analysis. Where are we? What does our seller want, and how can we fit this gap together? We only had to do little technical adjustments in terms of the competition, for example, how then the platform works. And based on this, we could move very fast forward, and we're already at the point where we thought about, okay, with which banks do you want to work with? And what we did there is we initiated a term sheet where every important aspect of the structure was written down, and this term sheet was sent then to all 10 relationship banks of our client. And 5 of them came back immediately and said, okay, we are interested to work with you on this solution, also with CRX. This was another challenge because some of the banks, they had to go through a new product process. And 5, as I said, were then happy to go ahead. With 4, we did then the final negotiation in terms of contract, in terms of then who is going to buy which debtor risk, etc. And then, we already went into the implementation. And actually, this was done within 9 weeks. And this obviously was a big challenge for all of us, for the seller, for the banks, and as well as for CRX. Usually, I would say, when you do a program like this, from the first meeting, or when you say, for example, okay, I want to implement such a solution, till go live, I would say usually it would take longer. I would say, yeah, to be on the safe side, between 3 and 6 months. It obviously always depends with which jurisdictions you are going to choose, which currencies, which debtors, etc. But this was quite fast. Nevertheless, we made it, and it looked like this at the end of the day when we put this in a picture. So we have the receivable seller in the middle, and different divisions also should be part of the solution. And they want to have the full flexibility to sell either single debtor risks or then also at a later stage, then a complete portfolio. And so they started on, and they're only doing this till now, single debtor risks. They're selling up to 10 debtors. And on the other hand, with the financing partners, they are currently only working with relationship banks. One factoring company has joined now recently, but we are not implemented, for example, so far, a portfolio solution where we use, as an example, an asset-backed security structure. Nevertheless, this is all possible out of one infrastructure. It doesn't matter how many divisions will join at a later stage this program, and the automation is ensured by a so-called SAP add-on, which then is responsible first of all for the communication between the SAP system of the receivable seller and the CRX portal, but it also takes the job of the accounting team. So for example, it uploads the receivables, then it posts the sold receivables, and the dunning process remains completely at the seller. And when they collect the funds from the debtors, also this add-on provides then payment instructions to the seller that they pay back the finance or the funder who sold the receivables. Here we have a look on the contractual structure. The master receivable purchase agreement acts as a central document. So this is always a trilateral agreement between the seller on the one hand, CRX, and the financing bank on the other hand. So actually in this case, we had to conduct 4 MRPAs. However, they are completely always the same. So that means not a single word is different in all the contracts. And this is then important that you ensure the scalability, that you ensure the competition, because when, for example, one bank would have more security than the other bank, they obviously could potentially price a debtor better than the other bank. And to avoid that, we said, okay, the document has to be word by word exactly the same. This was, I would say, one of the hardest challenges we had to tackle. At the end of the day, we made it, but we spoke before also with loads of corporates, and they didn't believe in it. The advantage here was obviously the seller has an investment grade rating, which makes then the negotiation with the banks a bit easier. And the contract we have here is also, I would say, seller friendly. Nevertheless, the banks have their own security standards. They didn't want to go too far away from that, but we made for all parties then the best out of this. And next to the MRPA, there's then a portal access agreement from the bank to CRX, as well as from the seller to CRX, and the fee letter. The fee letter means that CRX is charging a transaction fee to the seller directly only when they are really going to sell receivables. So there are no standard costs when, for example, no transaction is performed by the seller.
So don't be shy. There's the first question coming in, and it's about in what countries or markets is the solution available already?
we are live in Europe, so they're in different countries, in Germany and Switzerland, Austria and Italy, as well as UK and in the US. But in this structure here, in the contractual structure, we can add then different jurisdictions very easily. They are going in the amendments or in the attachments, and therefore, example, if then, for example, Spain would come on top, we would add an attachment, Spain law, so to ensure really the true sale of the receivable, and this makes then also the contractual setup very scalable. I think very interesting is to see the result out of this, and what you see here is what I mentioned. We started with 4 banks, Bank A, B, C, and D, and we started with 6 debtors. And BP means the base price, which is actually the highest price a bank showed to purchase the receivables from one debtor. And if we look at debtor 1, Bank A, charged or were ready to buy these receivables for the base price, but Bank B and C were much more attractive. So they were 45 or 42% cheaper than Bank A. The same is valid for debtor 2, sorry. And for example, on debtor 3, Bank E, the factoring company who only stepped in later, showed the base price. However, Bank A then was almost 20% cheaper, but Bank B obviously 39%. Nevertheless, the seller decided to give the allocation then to 2 banks because the debtor volume was quite high. The banks were then happy that at least part of these, that they could buy at least part of those receivables. And this is also another nice feature which we then developed together with our corporate client, that not only it's a best price execution, but you can also then do this kind of wallet sharing and say, okay, the banks put so much effort in, I want to provide them also with a kind of allocation. And that's why, for example, when we look at debtor 3, the price difference is quite huge. Nevertheless, they said, okay, Bank A put so much effort in, so at least they should get part of this this debtor risk, even they paid some basis points more. All in, including the CRX fee, we were able then to reduce the pricing by almost 40% based on the base price in average. And so yeah, it was a great success for the seller, as well as then obviously for CRX. But what you also can see very well here on this sheet, it's also an advantage for the financing banks, because they can actually focus on debtors, on receivables where they are where they can provide a competitive pricing. Bank B was the only exception who were really able to purchase all the different debtors. But if we then would add, for example, debtor 7, 8, 9, and 10, then they were also not able to buy all these debtors. And for example, Bank C only focused on 2 debtors where they could show a really competitive pricing. And so it was also for the banks the best out of 2 worlds. They were not, or they didn't have to buy the whole portfolio, which then obviously increases the price if they are can't purchase those receivables on their own balance sheet. And so the banks were also very happy with the solution. In the beginning, I'm also honest on this, it was it took us some time to convince them, but now also in other programs they see the advantages, and I used to work with CRX in such a solution right now.
Maybe one additional topic. I think even though, for example, Bank B was able to show prices for all of the debtors, it was not like only with the multi-bank solution, it was able to kind of cover all the volume which the seller wanted to sell via the platform. Because Bank B, for example, for debtor 1 was only to give a limit for, I don't know, 60–70% of the requested volume. So also Bank C was required really to give like 100% coverage. And this was only possible, as Tim said, with this multi-bank approach. Perfect. So the last topic on the agenda today is a brief market outlook in the field of receivables finance before we have some more time for your questions. What are the trends financial decision makers see in the field of factoring? So the clear winner with 77% is the digitalization of factoring. This is what we also could see in the questions we discussed before. So that really integration into systems, more digitalized process. This is something corporate treasurers look at. I think also digitalization is reducing costs in a way, the overall costs, which was also a very important criteria for treasurers to select a solution provider. The second topic is platforms and digital ecosystems for financing. So this was very obviously also a very interesting answer for us, as we offer a platform which gives access to the broadest funding network in the field of receivables finance. Other topics like ESG, of course, it's very relevant, I would say, in the bond market, for example, also in the supply chain finance market. There are many news around with new ESG linked programs in the field of factoring. It's still a bit like in the early days, but we also see the first ESG linked transaction in this field. Like the last topic, really, blockchain is something which is more like future. It is a topic we also look at, or we kind of monitor. We are watching this, but really in our day-to-day business and in the discussions with all of our corporates, it's not yet that relevant. And these are really the key trends all the participants of the survey see in the field of receivables financing.
One question just popped up, and it asked, would you say this trend is also true for markets outside of Germany?
I would say 100%. I mean, yes, the survey was conducted within the German-speaking area, but also we see the number of participants, which is more like an internationally focused webinar today. There are many participants, so it's clearly a topic which is interesting for corporations. And also look at all the different events, conferences. I mean, we will go to the ACT and to other events, and digitalization in trade finance platforms, it's a very relevant topic. So I would definitely say yes.
And then maybe, yeah, you can take this question as well. The question is, how many of these funding partners are also active on the receivable side, and how does it work to add an additional funder for such a structure?
So in general, on the CRX platform, we have more than 50 active financing partners. Looking at the receivables finance side, we have about 10 financing partners live. So this includes banks and also factoring companies. And the whole process of adding new funders, I mean, we have a dedicated team for this, our capital markets team. They are taking care of supporting also financial institutions in maybe a new product process and explaining documentation, how things work. Here, we are really focusing on our clients and kind of what financing partners they want to include in their supply chain finance or receivables finance program. So Tim showed you in the beginning some of the financing partners on our homepage, for example. You can see even more of them. And if you don't find one of your financing partners of choice, just ask us. We are very happy to always onboard new financing partners to our platform.
I think this is an absolutely very important topic for us, because CRX as itself, we don't provide funding. So we act as a marketplace. On the one hand, we have our receivable seller or the buyer in supply chain finance programs, and on the other hand, we have then the funding partners. And yeah, we are happy to work with any bank, or also non-bank investor, depending on the structure. And yeah, if you are willing to work with some of your relationship banks who are not working so far with us, as Daniel mentioned, we are more than happy to approach them together with you or bilateral, it doesn't matter, and to onboard them to our marketplace. No other questions so far? We can wait another 30 seconds or a minute. If you don't want to ask some questions now, obviously we are more than happy to have also a bilateral chat with you to really understand your requirements, your needs, and to see where CRX can add value. Therefore, please approach us directly, either Daniel or myself or the sales hotline. We are happy to help you. And still no further questions coming up. So I would say then, thank you very much for joining this webinar today, and hopefully speak to you soon. All the best and warm regards from Munich.
Bye.